Hey everyone, before we walk on to the core video for today, I have a very important message to deliver. I will deliver it in 3 simple bullet points. It is regarding the market correction that is going on. So point number 1, markets are correcting, no doubt about that. People are panicking and people are assuming that the markets are going to go to zero. No such thing is going to happen. You need to understand that the markets have been moving in the sideways direction for the last several months now, and this is something that I've said multiple times on my channel. So the current range for Nifty 50 seems to be roughly 18,200 at the top, and the bottom seems to be roughly 15,600. So that is the range in which the markets are moving. Second key thing, several good stocks in this correction have fallen more. For example, consider the case of HDFC AMC. Highly controversial stock. I will get a lot of heat for talking about this stock, but here are the arguments. Take a look at this chart and look at the 5-year return for HDFC AMC, and you will see that the run-up has only been 14-15%. 5 years return. So that is super low to begin with, right? So I hope all of us understand that. Number 2, look at the profit numbers, look at the growth numbers. The company is doing well. There is no massive problem per se. Now it's again, if you take a look at the industry overview, that it's not as if that people will stop doing SIPs, or the number of SIPs have come down, or the number of DMATs accounts have come down. Nothing of that sort had happened. Just because it was given growth projections, the stock has corrected a lot. Am I bullish about the stock? Absolutely, I am bullish about the stock, and this is not a stock buying recommendation. But the point that I want to deliver home is that several good stocks correct more sometime given the market conditions. You don't need to panic. If you believe in certain stocks, stay invested in it. Therefore, it is said that whenever you are picking equities, you should at least have 2-3 years horizon on it. So from that particular perspective, do not panic. If you are holding some losses on your portfolio, you should absolutely not worry about it. Third and finally, you might ask, okay, why has another round of correction happened? It has got to do with the inflation expectation. Everyone expected inflation to be high, even I have been saying it. And the data came out from the US that in November the inflation was roughly 7.5%. Now it has gone up to 8.5%. So even several macroeconomists got this thing wrong, that inflation will become so high, and it has literally gone out of control. That is the precise topic that we are going to cover today. So understand the macroeconomic argument around it. It will give you faith in terms of holding your stocks. Hey everyone, welcome to today's video. So on today's video, I'm going to have a discussion as to why taxes on you are going to go up from this point. Okay, not a happy video at all. Please don't dislike it and run away. Please listen to the entire arguments. I will try to propose some solutions as well. Just to kick things off, there are 3 specific graphics that I would want to show you. These are very, very important graphics. So please take a look and understand the macroeconomics behind it. I will explain it in a very easy to understand language. Here is the debt to GDP ratio of India. And you can clearly see from the chart that this indicates as 72.1. So what does this mean? It simply means that if India is earning 100 rupees, then the total debt on India, or total public debt on India, is 72.1. This is point 1. Graphic number 2, take a look at this. This indicates the same data for the US. Now here what you will see is that the total debt to GDP ratio for the US is roughly 135%. So what does that mean? That if USA earns 100 rupees, the total debt is 135 rupees. This is the story so far. Now comes the third interesting graphic. So this is something that you would have recently read, that the Nimbu prices or the lemon prices in India have skyrocketed. Retail rates 30 days ago was 50 rupees, then 15 days ago it was 90, then 7 days ago it was 200, then current retail is like 350 rupees. So basically Nimbus are going at a faster rate compared to cryptocurrencies. Super interesting fact, just tweet it. Maybe you will get a lot of retweets on this tweet. Anyways, coming to serious discussion. If you aggregate point 1, point 2, point 3 that I just spoke about, what you would notice is that, hey, India has been very frugal in terms of its maintaining its debt to GDP. It has been a very responsible economy. US has not been that responsible economy, but de facto terms, the mehengai in India is still very, very high. Why is that the case? I'm going to discuss. So 3 specific parts to the video today. 1, I'm going to explain it to you. Why mehengai in India is going up. Number 2, how is it going to impact you? Why your taxes will go up? And what will be the impact on India specifically? And third and finally, what is it that you can precisely do? Also, a very quick shout out to our sponsors for today, which is Wint Wealth. It is an excellent bond investing platform. If your risk profile aligns with bond investing, you should definitely check it out. I am personally an angel investor in this company. I love the team. Therefore, I have made investment in this company. So you can check it out. And if it fits with your profile of bond investing, you can definitely consider investing through Wint Wealth. Let us get the video started. First core topic that we are going to discuss. Why is the world becoming more and more and more expensive? Short answer there, it is because of the fact that government have played very dumb.
right? This is not just me saying it, and it's not my personal opinion. This is the opinion of The Economist as well. And this is the recent cover of The Economist magazine, where they have categorically called out that Feds have failed in terms of controlling inflation. Now, this man-made disaster of high inflation and high mehengai in the economy can be understood through three simple points. Point number one, take a look at the total money printing that has been done in the economy by the US. And here you will clearly see that post 2008, there is something called as quantitative easing that has taken place, which is just a fancy way of saying that, hey, we are the government, we can print infinite amount of currencies. So let's start printing, turn on the printer and let's have some fun. Okay. So they had a little bit of fun here. And then in 2020, they went like absolute berserk and they started printing money like crazy, and printing more money became the solution for any problem that existed in the world to the US government. Now, the problem is that US economy is not just the US economy. If US Feds or US economy undergoes a certain change, if it acts in poor spirit, it impacts the whole world, including India, in a very, very bad way. This brings us to the second point, that due to excess money printing, that there is just so much available money in the economy that the inflation in the US skyrocketed. So up until November, December, the monthly inflation data came out to be roughly 7.5%. I personally thought that would be the end of inflation, at least in terms of peaking of inflation. And now the world will start some remedy process around it. But no. Recently, March data was released and the numbers look even more scarier. It's hitting 8.5, the highest in the last 41 years. And just to set some context, a healthy rate of inflation for an economy like the US should be somewhere around 2 to 4%. It is hitting 8.5, which is absolute crazy numbers, and it has started to have really bad impact on the entire world. Now comes the third point, that okay, this is all like hi-fi data. Why does it matter to me? Okay, it should matter to you because your taxes are going to go up, and let me explain it to you systematically why. So take a look at this chart. This shows the relationship between inflation and the increase in taxes in the US. Why have I picked the US data? Because the US data is very well recorded and it's very clean because it comes from a developed market. I'm not trying to criticize emerging markets. I'm just trying to say that the data in the US is very, very clean. So if you take a look at it, there is a very clear correlation, and the prediction says that the taxation structure would have to readjust in such a way that it will be 3% up for US citizens. Right? So please note this point. This is a very, very important point. I could not find a study that was done in the Indian context, but you can extrapolate that US data to India and try to ascertain who would be paying that 3 to 5% tax that would be levied across economies. So there are three options here. So one is that, hey, the taxes could be paid by corporates, rich people. Second, it could be paid by salaried class. Third, it could be paid by poor people. Now, unfortunately, we can eliminate this class very, very easily and commonsensically. Why? Because poor people do not have discretionary income and they are not hitting that income level to pay any tax, or for that matter, any additional tax. So by default, two options remain. One is corporate and one is salaried class. Now, the problem with corporate is that right now, in the short term, corporates are taking a hit. For example, if you take a look at the Indian market, FIIs are going away. Lot of corporates have had very poor results over the last 1 year due to series of problems that exist, and they are high debt. There are a bunch of different problems that Indian corporates and even Western corporates are suffering. Why? Because there is severe cash crunch that has started to appear in the economy. Debts that have been taken, they are maturing. Companies are defaulting. Even the entire real estate bubble in China had recently happened. So basically what the corporates would say that, you know what, short term, we are facing a lot of pain. We can't pay higher taxes. And if you make us pay higher taxes, we are going to wind shop from a country like India and we are going to go away. That has happened numerous times in the past. So therefore, corporates escape from paying this higher amount of taxes. So by default, on whom the burden of taxes would lie? You guessed it right, and let me know in the comment box as well. It would lie on the salaried class. Now, how would you pay higher taxes? Because if the government comes to you, say that, you know what, you are paying like 30% tax, pay me 35. Are you going to pay it? I don't know. You would have no option. You will have to pay it, but you will feel supremely frustrated and it becomes a political nightmare for the government. So how exactly this game is going to play out? Let me give you a very quick viewpoint on that. Now, what happens is that government cannot come to you and say that, you know what, pay me higher direct taxes. They cannot increase your taxation rate from 30 to 35% because it becomes obvious nightmare for the government. A lot of people will get miffed with it. So government adopts two specific strategies here. One is that they allow you to subsidize corporates. How do they do it? Take a look at this particular chart. This shows the price rise of Unilever products in alignment with the inflation. So every time the inflation goes up, Unilever keeps on increasing its prices over and over again. And Hindustan Unilever has done the same in India. Even the product prices have gone up by 15%. I'm using HUL or Unilever as just a proxy. This strategy is adopted by several major brands. So essentially what happens in this game is that in the short term, everyone is suffering. Salaried class is suffering, poor people are suffering, corporates are suffering, and corporates logically increase their prices. No problem up until this point. But the problem area happens that when this situation goes back to normal, it might happen after 1 year, 2 years. Then what would end up happening is that these corporates are not going to roll back the prices. So this becomes like a long-term tax for you. Now you would say that, okay, what is government's fault in this? Why are you pinning this on government? Government's fault is that despite these companies making substantial long-term profits, government will not increase their corporate tax rate. This is the problem. So who is subsidizing for this increased inflation in the long term? It is people like you and me. Now comes the second point that, okay, Akshat, hey, this way, HUL, Asian Paints, Unilever, these type of companies are making profits. But how is government making money through all this? Okay, they are making money through several ways. Once, if the corporate profits goes up, Indian government collects a lot of corporate tax. And second more important point is that right now, within a few months, what you will see is that there will be increasing of peripheral taxes. For example, they will play around with the GST slab rates. They will play around with like education cess. They will play around with a bunch of different cesses. So these type of additional taxes will be imposed on you one way or the other. That's part A of this equation. Part B of the equation. Here is the chart which shows that if you go and buy iPhone in the US, it comes out to be much more expensive than buying iPhone in India. You would say that, okay, what does this have to do with the government? It has got everything to do with the government. Your iPhone prices in India are expensive because of the import tax that government is levying. And who ends up paying that import tax in a way? The incident of that tax or the proportion of that tax is the highest for people buying that iPhone, not on Apple as a company. So I hope you get the picture that in the long term, it's people like you and me who will end up paying majority of these taxes due to increased inflation in the economy. Now comes a second and a very interesting section, which is about that what would be the impact on India due to this increasing महंगाई in the world. There are going to be 4 specific impacts on India. The first is that the cost of capital in India is going to get even more expensive. Now, what is meant by cost of capital? It simply means the rate at which India gets to borrow from the world. You might have recently seen that the interest rates in the US are close to 0%, but in India or emerging economies, it is very high. In fact, in Sri Lanka, it has become like crazy high, that the borrowing cost for Sri Lanka is crazy high. It's very high for Nepal. It's very high for Pakistan. Why? Because if you look at stronger economies, if you take a look at the US, they are the strongest economy. They have the reserve currency. So their cost of capital is lower. They can borrow at 0% interest rate. But the cost of borrowing will increase for emerging economies, India included in it. So therefore, the cost of capital in India is likely to become higher. Second key problem we are going to have, it is called as imported inflation problem. Imported inflation problem simply means that in the US, the inflation is very high. Now, India as a country imports a lot of stuff from the world economy, including the US. We are a net importer, not a net exporter. So therefore, if the world inflation is going up, which includes the US, our inflation will automatically go up. Now comes the third point, and I would want you to refer to that earlier chart that I was speaking about, which is around public debt. The third impact that this high महंगाई of the world will have on India is that our public debt is likely to rise. India was growing at a moderate pace before COVID happened. There was already a lot of pressure on the Indian government to grow the Indian economy at a brisk pace. So how do you grow the Indian economy? There are 2 ways of doing it. One is that you increase your GDP production so that you get more money. You use that money to build more roads, bridges, etc., etc. And as a result, your economy will grow further if you are undertaking more productive expenses. The second option is that you need to borrow money. Now, unfortunately, the world has gotten stuck in a rut where the flow of capital has really dried out, right? You might have recently witnessed that a lot of new age startups have postponed their IPOs. They are not launching their IPOs this year. They will push it to next year. Lot of well-funded unicorns have started firing their workforce. 10-15% workforce really gone. So what is precisely happening? Why is this happening? Because these new age companies are not able to raise new money. They are not even able to borrow from the market that easily. It is a sign of funds being dried up, generally speaking. So in government's case, what is going to happen is that government would try to borrow more money and it will have to pay a higher interest rate. So therefore, this debt to GDP ratio that you currently see, it is going to shoot up. I'm not saying that it will completely go haywire, but yes, the cost cost of borrowing will increase for India because the public debt is going higher. Now comes the fourth and final point, that when it comes to discretionary products in India, they are going to become even more expensive. This includes fridge, TV, ACs, car. All these different things are going to become very expensive, and that is one of the reasons why these discretionary / auto stocks have also corrected quite a lot in the last 1 year. For example, take a look at this particular graphic. It shows that the Audi prices in India are almost 2x than what you would find in any other part of the world. Why is that the case? Because it's a discretionary product. It's a luxury discretionary product, in fact. So if you're trying to buy such discretionary luxury items in India, it is going to get super expensive for us. Now, how does this impact the Aam Aadmi? You will clearly see housing rent going up, school education fees going up. You will see transportation cost going up. So generally, there will be an increased price rise in a country like India simply because of the fact that cost of capital is increasing and public debt is increasing too. So this is the scenario that we live in. Now I've painted a very negative picture. I understand it. This is the reality that we are living in. And that is the reason why, if you take a look at Nifty chart right now, it has been trading sideways for almost a year now. Now let me conclude the video by speaking about a few options that you can execute in order to somewhat hedge against these increasing prices. So step number 1 is that you should definitely invest. It's not about where you are investing, you just have to invest. If you keep your money simply in your bank account, it is going to get wiped out. It is already getting wiped out. For example, the FD rates are hovering around 5.5%, and inflation is hitting 7% in India. So you are definitely losing a lot of money if you're not investing. So please invest somewhere. That's step 1. Step 2. Please identify assets where the rate of interest is more than 8%. You can consider investing in some bonds through Wint Wealth also, or if you want to take some positions directly in equity, that is also great. No problem there. You can have a mix of bond plus equity because of the volatile environment that we are currently witnessing. Third specific point, while you cannot do anything about taxation, because if the tax, whether it's indirect, direct taxes, it will go up, it's almost given. And it is also given that salaried folks are going to take major brunt of those taxes. My advice would be to diversify across different geographies. I personally feel that markets right now have come to a somewhat sensible levels. In the US, you can consider taking some positions in US based stocks as well. It is important to be geographically diversified because when the India's public debt to GDP ratio goes up, we don't know how the FIIs are going to further react or what that short-term problem in India might be. Have I become bearish on the Indian economy? The answer is absolutely not. I'm very much bullish on the Indian economy, but right now, given the circumstances, it makes sense for us to be diversified. And diversification is something that I've always advocated, and I will continue to advocate that. At the end of this somber discussion, so the word of the day today is somber. Let me know what does that mean. So at the end of this somber discussion, one ray of hope is that the world has gone through 2 major crises right now, and India, despite being an emerging country, has survived, and our economy is somewhat in an okay shape. So going forward, as the world kickstarts its growth engine, I'm confident that India will start churning its growth engine really fast compared to the world. But yes, till the time the world growth is not happening, India will continue to suffer a lot. I hope you enjoyed the discussion. Please press the like button, and I will see you tomorrow.